Do you know that the new UK tax has just started and all the tax and money changes are now beginning to reflect in my household budget? And I think it's going to be the same for you. But these new changes are not interesting at all in terms of how they're affecting my budget. You see, the other day when I opened my bank app, my heart dropped. And I was like, oh, my council tax payment has just gone through. And it was 8.9% higher than what I paid in March. And I thought, hold on, did I miss anything? Nope. But I just realized then that the UK tax year has reset. And when it resets, it comes with a wave of financial changes that are already shaking household budgets. But here is the thing. It is not just the council tax that will affect budgets. There are other major money changes that have been rolled out across the UK. And some of them could quietly cost you hundreds. So whether you rent, whether you own a home, or you're just trying to save to have one, it will affect you. Promise you. My name is Funke Ogunjobi, a qualified accountant with over 15 years of experience in the financial sector. On this channel, I break down money matters, tax tips, and financial changes in a way that actually makes sense. So if you're ready to take control of your finances without the jargons, you are in the right place. So in this video, I am going to walk you through 7 key financial changes that has happened in April 2025 that could affect your paychecks, your bills, and even your long-term savings. So let's unpack what these changes are, why they matter, and how to stay ahead before they begin to wreck your wallet. Let's break it all down. So the first money change that I'm going to talk about is the national minimum wage. The national minimum wage, if you don't know, is the legal minimum hourly rate that employers in the UK must pay most workers, depending on their age and whether they are apprentices. So this amount is set by the UK government and it is reviewed annually, typically increasing in April to reflect inflation and changes in the cost of living. So what has changed in this new tax year? So if you are age 21 and above, your new minimum wage is now £12.21, up from £11.44p previously, which is 6.7% increase. And that means you're having 77p more than what you would have in the previous tax year. And if you are ages 18 to 20, your new minimum wage is now £10 an hour, up from £8.60 in the previous tax year, which is £1.40 more. And that is 16.3% increase. On the routine, and if you are an apprentice, you now earn per hour £7.55, which is up from £6.40 that it used to be in the previous tax year, and also giving you £1.15 more hourly. That is 18% increase that you now have in the new tax year. Now let's do the reality check. While this sounds like good news, let's be honest, does it really help when other costs are skyrocketing? So for example, a 21-year-old working as a waiter, he does 35 hours per week, now earns £423.50 per week before tax. That was up from £440 that he would have had in the previous tax year. But with rising bills, that extra £23 may barely cover the increases in groceries, rent, and travel cost. So while his pay slip shows small, his wallet might not feel it. The next one I'm going to talk about is council tax. Council tax, if you don't know, is a local tax charged by your local council to help pay for public services in your area. So think of it like a contribution towards keeping your community running. If you live in a house, whether you own the house or you're renting it, you will likely be paying council tax in that area. So what is your council tax used for? The money goes towards essential local services like rubbish collection and recycling, street cleaning and road maintenance. They use it for schools and libraries. They spend it on the police and fire services. Also, social care and community support take a portion of the council tax. So every time your bin is collected or your kids go to the local school, your council tax is partly funding that. In my area, for example, like I said earlier, council tax has increased by 8.95%. You can round it up to 9%. That's a lot. And what it means for an average family in my area on a tight budget is they will now be paying between £280 to £400 extra on their council tax. Now the question is, where will they get that from with earnings and incomes remaining static? So it's either they cut their grocery budget or they cut their savings budget. One thing will have to give way for the other one to happen. That is what everybody is going to face this new tax year. And this is the best time for budgets to be done in every family. If your family is not keeping any budget before, you have now the best time to start looking into that. So the third one I will be talking about is called personal allowance. Personal allowance is the amount of money you're allowed to earn each year that is tax-free in the United Kingdom. So that means that before HMRC starts taking any income tax from your salary, from your freelance income, that is the money you earn on any e-commerce platform like eBay, Amazon, Etsy, and others, or your pension, or your savings interest, that is the extra money you've made from your stocks and shares. Before they tax this your income or this your earnings, you're entitled to keep a certain portion of this income away as tax-free. The government is never going to tax it. And that in the previous tax year was £12,570. So what has happened in this new tax year is the government has now made that amount static. If they've not increased it, a lot of people were expecting that it was going to go up. And the thing is, despite rising living cost, personal allowance is still remaining the same. So what it means is if your salary increases, but the personal allowance is staying the same as it is currently, you're essentially being taxed more without you seeing the real gains at the end of the day. Economists will call that fiscal drag. So it means your wages isn't rising with inflation, number one, and then you're getting the same personal allowance as you had before, number two. So what would happen is you have less of your money to keep or to save. Everybody will have to feel the hate of this at some point in the year. Let me know what you think about personal allowance staying static in the new year in the chat section. And I want to know also, do you think it's a good tax decision that has been taken by the Labour government, or you think they could have done better? Whatever it is that you think or you believe, drop it in the comment section. The next one I'm going to talk about is the stamp duty. I'm just going to say here that buying a home just got pricier. What is stamp duty? Who needs to pay it? Stamp duty land tax, that's the SDLT, is a payment you make to the HMRC when you buy a property or you buy a piece of land in England and Northern Ireland. Stamp duty equivalent in Scotland is called the Land and Buildings Transaction Tax, LBTT. In Wales, it is called Land Transaction Tax. But I'm just going to focus on England and Northern Ireland. So what it used to be for first-time buyers, no stamp duty on your first home if it is up to £425,000. Also, if it is your second home in England and Northern Ireland in the previous tax year, you're not paying any stamp duty if the property is up to £250,000. Now, what has changed in the new tax year? As a first-time buyer, you're only going to have £300,000 tax-free, meaning that on £300,000, you're not going to pay any stamp duty. If it is your second home you're buying, only £125,000 will be tax-free. So what it means is there has been a change to the prices, and then any extra pound on top of whatever is the threshold now will incur a stamp duty charge. You have to take note. So let's say Emily is buying a first flat in London for £400,000. Before, she paid a 0% stamp duty on that for £100,000. But in the current tax year, she would then have to pay 5% on £100,000, which is above the new limit, and that is £5,000 that she will pay as SDLT. It's a big hit for buyers already struggling with high mortgage rates and deposits. I would like you to tell me in the comment section, if you're planning on buying a house, what are you thinking? What are the things you're trying to do to make sure that, you don't get to that threshold limit, or even that is the price that you're going to get your house for? How does it feel? Can you just share that with me in the comment section. So the next one is electric vehicles tax. The government has decided to say that there is no more free rides for anyone. So EV or electric vehicles are those vehicles that can run entirely or partially on electricity instead of petrol or diesel. They use batteries and electric motors to operate, making them much cleaner for the environment because they produce zero emissions. So what was it before this tax year? Previously, electric cars were exempt from road tax as an incentive to go green. So they were paying zero road tax. New changes from this new tax year. All electric vehicles registered from April 1st this year will pay £10 for the first year on road tax and then £195 annually. So old electric vehicles registered between 2017 to 2025 will also start paying the £195 on an annual basis. So example, Alex bought a Tesla in 2022 thinking it would skip road tax forever. Now it would need to budget an extra £195 per year starting now. Would you still consider buying an electric vehicle even with the new changes to its road taxes? Let me know in the comment section. Talking about is the national insurance. The national insurance has really gone up, especially from the perspective of the employer. So what is national insurance, just in case you don't know? National insurance contributions are a type of tax on earnings that is different from the PAYE that comes on your income tax. So it's on earnings. There's a way the government calculates that. What is national insurance contributions used for? It is used by the government to fund various benefits, including the state pension, the job seekers allowance, maternity allowance. They even take some of this to fund the NHS. And what it was before in the previous tax year was employers were paying 13.8% on national insurance only after a particular staff or worker has earned more than £9,000 annually. But in this new tax year, the rate has gone up. Employers are now going to be paying up to 15% on each worker that they employ. And also the threshold has now dropped from 9,000 to 5,000, meaning that employers now have to pay for more headcount than they used to in the previous tax year. And the increase in the national insurance contributions plus the lower threshold from 9,000 to 5,000 mean higher employment cost for businesses. So to manage this increased cost, many businesses are considering, number one, raising prices. Retailers are already anticipating to pass this cost on to consumers, potentially increasing prices by up to 4.2%. So a lot of things are going to go expensive. And some of them are actually thinking of reducing staff hours or headcount. So survey indicates that over half of businesses may cut paid hours or reduce staff to cut off some of these expenses. And for you, the employee or the worker or the staff, you won't see a direct change on your payslip, not at all. But indirectly, you are going to go through, that small wage increases, because a lot of businesses will not be willing to increase salaries so that they don't have too many staff fall within the bracket that they would then be paying a lot of NI at the end of the day. Another thing that you would experience indirectly is increased risk of job cuts or reduced hours. Another thing that you may experience is higher consumer prices, as businesses are going to pass on the cost onto the consumers so that their books can balance. And this is another area that is going to affect mostly everyone in the United Kingdom. Again, on this one, I would just like you to tell us what you feel in the comment section. Are you already feeling the heat? Are you a business owner, or are you just a self-employed person that is thinking, how will I cope with this at the end of the year? I want you to put that down in the comment section. And also, if you are just a staff of an organization and you are not sure how this is going to indirectly impact you, also let me know in the comment section, and let's see what you have and see how we can support one another on this employers' national insurance that is going to affect the majority in the United Kingdom. And the last but not the least, I've got capital gains tax. Now you've got to listen. Selling your assets could cost more. What is CGT? That is capital gains tax. It's a tax on the profit when you sell or dispose of an asset that has increased in value. The gain you make is taxed, not the total amount that you had received. So common assets subject to CGT would include shares, your stocks and shares, investment funds, your second homes, business assets, etc. In the previous tax year, a basic rate taxpayer on anything they have sold, any asset they have disposed of, would pay 10% on the profit made, but now it is 18%. A higher earner that has sold off any asset and has gained any income from it previously would pay 20% on the gains, but now it's increased to 24%. I'm going to give a real life example so that you know how this is going to impact you if you fall into that category of selling off any of your assets. Say Pricier sold some shares that she had held for 5 years and she made £10,000 profit. In the previous tax year, she would have paid £1,000 in capital gains tax. But in this current tax year, she will be paying £1,800. That is almost double. So if you're planning to sell property, you're planning to sell your stocks or valuable assets this year, this change could bite. For those who have businesses, business asset disposal relief that you know as BADR and investors relief had also changed. So the CGT rate for qualifying disposals under BADR and investors relief is going to increase from 10% to 14% from this tax year 2025 and will go up to 18% come 6th April 2026. The lifetime limit for investors relief will be reduced to 1 million, aligning it with BADR. See, the government is looking for every little way to suck up all the extras that anybody would make in the current year. Is that a good thing? Or you think the government is being unkind to, our welfare and also our pockets in this current tax year? I would like you to leave your comment or whatever it is that you think in the comment section. So the reason for this video is just so that you stay ahead of the game, you plan ahead as well, and you start building that better financial decision for yourself and also for your money. And if you want more updates like this, let me know in the comment section. And I want to know also which of these changes is actually hitting you the hardest. Is it the rising bills? Is it the tax thresholds or the house buying cost? I will read every comment and I'll try as much as possible to reply. So if you found this video very, very useful and helpful, don't forget to hit the like button. It's taken a lot of time and effort to pull this together. And I would so be motivated, by your liking and your subscribing and your sharing of this video. And also, if you want more on UK money tips and news, just let me know. And until next time, stay informed, stay prepared, and thanks for watching.